Good afternoon. I'm glad to be here to discuss my final mission in life, something a bit entrepreneurial and maybe disruptive for the retail investment world. You're really among the first to see the idea and see how it works well. I do have experience as a professor of finance and academics where I was writing technical articles for that academic audience, and then tried to go ahead and see what it would be like to practice what I preached. As Joe alluded to, we spent a lot of time together. I spent a full 15 years at Smith Breeden Associates, which was institutional investment management, where our clients were pension funds and banks and central banks and alternative hedge funds, et cetera. And we had the opportunity there to build models for use by our portfolio managers and traders for things like asset allocation and risk management and sector rotation and security selection. So my focus more recently has changed. When I hit 65, I retired from all activities except editing the Journal of Fixed Income, and thought the reason I did it at 65 exactly was because I felt I only might have another 10 years or so of being able to do outdoor activities. My love for snow skiing, hiking, backpacking. So I moved to the Colorado mountains. In fact, the background you see is my backyard. I live at 9,300 feet. And it was great. All three of my children were married and were giving me grandchildren left and right. I have 7 now. So everything was really good. And I was enjoying this retirement life. And then my kids asked me, gee, Dad, I have money in a 401k, and so does my spouse, et cetera, all 3 of them, that's 6 of them. And they said, how about helping me with my investment decisions? So I said, okay. I started lecturing them about all the investment concepts they needed to know about, and they quickly said, stop, just tell us what to do. Better yet, do it for me. So I said, well, that's only going to work in the short run. I'm not going to be here forever. I like the thought process of rather than giving somebody a fish, teaching them how to fish so they could be independent. And so here I needed to figure out a way for them to be educated enough to not need me. And that's really my goal. I keep telling my family and friends that I help out with their investments that I want them not to need me. So I started out with a simple process of building spreadsheets. And many do-it-yourself investors do keep spreadsheets of all their investments and try and have some order to what they're doing, some structure. The spreadsheets I built was to first obviously have all the information in all the accounts, but also to bring in information to analyze all the individual securities and how should I evaluate their risk and how is all this going to roll up into a portfolio of risk dimensions? So I started working on that, and then I started writing some things down. So I said, well, maybe this could be helpful for more people than just my children and family. So I wrote the book, Do It Yourself Wealth Management, and to give them some of the concepts in a non-technical way as much as possible. And then as I would review with my kids their portfolios every few months with the spreadsheet, and I had to put in a lot of laborious hours to update them, My two sons are technologically very sophisticated, and they said, a lot more of this could be automated. And automation is really the key to get them to implement, because they don't have a lot of extra time. They have careers, they're very busy, and it might seem overwhelming. So, but they said, if we could really automate this, and technology in finance, frequently called fintech, has really advanced over the years. So let's take a look at that. My proposition that you'll see throughout the book as well is that it's not difficult to do better for yourself than what most professionals can do for you. That sounds like a pretty aggressive statement, okay? But my concern is also, even for those that are wealthy enough and would afford to pay advisor fees, that they also have a responsibility to monitor them and be able to ask relevant questions about suitable strategies and performance. So to give you a feel, I will, shortly after this quick video, back up some of the ideas that are in here.
We all want to have control of our financial future, to take care of ourselves, our family, and to do what we love. But this can get complicated. Anyone selling an investment product has a potential conflict of interest, and the interactions among many accounts and strategies seem impossible to manage. Robo and financial advisors miss your whole picture with cookie-cutter strategies. High fees and expense ratios diminish your wealth accumulation. Wealth portfolio management is often characterized as unattainable, time-consuming, and beyond our capabilities. We are changing that. Here at Ripsaw, we believe that you are the best person to be in control of your decisions. Ripsaw is an independent platform that provides a set of tools for you to make investment decisions in your own best interest. A customized benchmark establishes objectives, and the dashboard aggregates all assets and liabilities into a set of portfolio risk dimensions. Before executing any trades, evaluate what-if changes in your revised portfolio and its risk exposures relative to your benchmark. When your plan is suitable, execute trades in your brokerage accounts and see it afterwards refreshed in Ripsaw. Ripsaw is changing what it means to manage your wealth by putting you in the cockpit. Join Ripsaw and take control of your financial life. Sign up at ripsaw.co today for a free trial.
Okay, so that was really the elevator pitch, as they call it. But let me back up a lot of what's in there. Low interest rates. We've been in a low interest rate environment for a good decade now. That really implies to me that advisory fees are unsustainable at the levels they are. Now, let me give you a backup feeling for that. I'm much older than all of you out there. So I remember the mortgage rate at the time I bought my first home in 1982. The mortgage rate was 18%. Long-term treasuries were 15%. So that means your expected return on stocks was over 20%. So if you have to pay 1% for an advisor and another almost 1% maybe in the expense ratios of the companies, the funds that they invest in for you, that doesn't feel so bad if you're going to make 15 to 20%. But today, the long-term treasury bonds around 2.34%, and treasury bills are effectively 0.01%. And your expected return on stocks then is in the 7 to 8% range. So if you have to pay 1 to 2% in fees, that's a big percentage of your potential investment return. Cookie cutter model portfolios have been the rage in the investment community for many years. What the investment profession does is say, well, if we can put you in a bucket, let's say you have income objectives where you're preserving capital, or you have balanced objectives, or growth, or maximum capital gains, which is kind of all stock. If there are 4 or 5 categories that we can put our 100,000 or so clients into and give them all the same portfolios, that's a lot of operating leverage for us, okay? But having model portfolios doesn't represent your individual uniqueness, okay? I'll give you a few examples shortly of this, okay? Unnecessary complexity and opaqueness of portfolio composition. If you look at, in my book, chapter 4, I do a case study. And in that case study, from maybe the largest, if not one of the largest investment firms managing for retail consumers, when you look at the statements, first of all, they don't tell you very much, okay? They don't tell me much about the risks of the individual investments. They'll never show you all the fees on there. You've got to dig deep to find the advisor fee, let alone the expense ratios are never there. And they try and make it complex. The one that I looked at there had 35 funds in one account, okay? All offsetting each other. The interrelationship is never analyzed. And part of that purpose is so you look at it and say, wow, that's complicated. Just do it for me. I don't want to know. It could be made very simple, as I do in that example. And finally, poor performance of the funds that they're putting you in. So let me give you a very quick example. Suppose you're 35 years old, have $100,000 saved up towards retirement. You contribute $15,000 per year for 30 years. If that portfolio earned 8%, at 65, you'd have $2.98 million. But if you were paying fees of 1.8% along the way, your wealth accumulations reduced to 1.95 million. That's over $1 million decline or loss of wealth accumulation, 34%. Now you might start dividing, 1.8 over divide by 8%. So well, that's less than 25%. The 34.33% comes from not just your annual expenses, but the opportunity cost of having that money to reinvest at 8% for those 30 years. Okay? Now, some might say, well, 8%, you're undercutting me. No, in today's world, I pulled this table right from your textbook, and it's sort of helpful to think about, I'm using historical data, but how does that help me project what I'd expect in the future? So here you have from 1927 to 2018, T-bills averaged 3.38%, common stocks 11.72. So what is the compensation for having investors move from riskless T-bills to all the risk that's in common stocks? Well, that difference is 8.34%. That's the risk premium. And that risk premium was for 20.05 standard deviation. So what should we expect today for stocks? 0.01 is today's T-bill rate, plus 8.34 is 8.35% expected return on stocks. But that would be for a 20% standard deviation. Today, the expected future standard deviation on stocks is about 17. So it would be less than that 8.34 risk premium because risk is perceived to be lower. I got that number 17 from the VIX. VIX is the implied volatility that you get from options on the S&P 500 index. That is forward-looking, not backward-looking. But we'd expect the risk premium to be lower for less risk. So today's stock should probably be earning expected in the future at around 7.5%. And actually, if you did a portfolio that was 60%, 40% stock, my expected return would be down towards 6 to 7%. And if it was 40% stock and 60% bonds, it would be down below 5%. So think about the percentage you're paying of your return in the form of expenses. So when I said that these investment advisors are really only concerned with the assets they have that they're managing for you, not your other assets. But when you think about wealth management, it's all your assets and it's unique to everybody. So your primary home, if you got a vacation home, investment properties. How about debt? Your mortgage. Your mortgage is a short bond position, and it's really part of your bond portfolio, as well as all these other potential sources of debt. Your wage income is an issue, business income, private investments. Yes, so, you can tell I have an investment it's self-funded in Ripsaw Wealth Tools, and actually Ripsaw LLC, and that's a small stock, a micro cap, all right? But it's part of my stock portfolio. So when I think about my allocation to small stocks within my entire stock portfolio, I need to include that. So I would use less of a small stock allocation elsewhere than others would. Unique to me. Social Security, pensions, annuities. When you get towards retirement and you start collecting these are like bonds, okay? They're like interest-only bonds and need to be modeled as such, and it should be part of your bond portfolio. And we do that in Ripsaw Wealth Tools. If you have vested, unvested, restricted stock and options, all that should be part of your portfolio. When I started thinking about my kids, 30-something dual career families with 2 children, wow, 11 accounts really quickly. They really mount up. So how am I going to manage all the accounts at once with all the individual investments and what should go in what account? Okay. 401ks, I was really disturbed. And in the book, I talk a lot about, and in that case study I mentioned, the choices in many 401ks are very limited, and they come with very high expense ratios. So what you're going to want to do is you have to use it. So you use the least bad option, okay, that's in there, and then you work around it in other accounts to get where you need to be. Okay, so this is the important point of managing all accounts simultaneously. How about performance? How well do active managers do relative to index funds? Well, the orange area, which is the bulk of all these pie charts across all different strategies of stock investments, from domestic all to small cap, mid cap, large cap, et cetera, value, blend, growth. Notice the orange area is the largest area, okay? There's no case in here in which at least 50% of active funds beat the benchmarks. In fact, more than 90% on average do not beat their benchmarks. Right? So you can also do better by yourself using index funds that are low cost. Internationally, they don't do very well either. And here's for bond funds. And again, they don't do particularly well, but it's interesting when you look at one that's a little closer, like these intermediate investment grade funds, okay? Now, these are mostly comprised of treasuries, corporates, and mortgages. Now, if you're a long-term investor, you say, well, you know, corporates and mortgages have a risk premium in there too. If I use a little less treasuries and a little more corporates and mortgages, on average, over time, I should win. And that's what most professional managers of core investment grade funds do. They just tilt their portfolio to spread product. But that requires no special information. You can do that on your own. So you want to take advantage of your position in the marketplace. If you're a long-term investor, you can do these things for yourself. So what's the implication? Do-it-yourself investors should use low-cost index funds on their own. Okay, all right, that's an interesting, sensible principle. The question, though, is which one should I use? And how much should I invest in each? And which ones should I put in which accounts? Oh, that's a little more complicated. So what we need is a platform, a user-friendly platform with a disciplined investment process that doesn't have conflicts of interest, okay, of selling particular products that they get commissions for and so forth. Okay. Now, if I have all that, I can do portfolio construction, monitoring, and revision. So here's the vision thing. Okay. I'm thinking about creating this platform, and what do I need? I need data that's personal. Okay. So I want in read-only form. I don't want any control over anybody's brokerage account or IRA, but I want to be able to access them and say, well, what do we have invested? How much is invested in each one, each investment? But then what I also need is data that has risk information on all these individual investments and information on the market environment. Now, can I download that? Can I get that efficiently? Now, if I can put those two things together, then I can build models around how to use it and how to do some analytics around it so that I can create and manage wealth portfolios that are consistent with the investor's objectives. So I pulled this out of your book from the last chapter, your textbook. And this is a flow chart for a disciplined investment process. And it's the same flow chart for an individual as it would be for an active investment manager, as Joe and I did for pension funds with a particular mandate. Okay? So what we have in here in the upper left is the investor's characteristics. What are their constraints and objectives, and what's their risk tolerance, and what policies may or may not be appropriate for them and strategies. In the lower left, we've got the investment opportunities. So we need to gather all this market information and form expectations about what the returns are going to be on individual securities and what the risks are and all the sector information we might need. So when I impose the investor inputs on the investment opportunities in this financial modeling section here, right in the middle, that's where I'm doing portfolio construction, revision, asset allocation. Let's use an optimizer, portfolio optimization, and that'll result in my security selection, implementation, and execution. Okay, all that's great stuff. And we've got feedback loops. Okay, as time marches on, new information comes into the market, and that will also, I'm in contact with my investor and see how they may have changed any of their outlooks. And very importantly, in this far right box, is performance measurement. Are we achieving our objectives? How are we doing? And use that as a feedback loop in order to improve future performance. Okay? And next, I'm going to show you another interesting set of figures from your textbook. Presumably, you've been through all this, and what you learned was, well, in what we call expected return standard deviation space. If all we need to know to summarize these individual investments is what the individual expected return and standard deviations are, they plot in this area called this opportunity set of risky investments. So there are a lot of little dots are here for all stocks and bonds, okay? And once we know their correlation structure and effectively what we call a covariance matrix, we can solve for all these points along the risky efficient frontier from D through P through E and so forth. And these are all points that for every level of expected return, what's the minimum amount of risk? What portfolio can I solve for that has the least amount of risk for every expected return? And then we also know that we have an opportunity to put money in T-bills at no risk. Right? If I combine that with any of these portfolios, D through P through E, they'll give me a slope. That line will have a slope of expected return per unit risk. And the highest one is what we'd be looking for. So our best opportunity set is combinations of T-bills and portfolio P, okay, where we're lending, we're investing in T-bills and P. And then if we want to get really aggressive, we could borrow at the T-bill rate and invest more in P and move along this capital allocation line. Well, that's a lot of portfolios. Which one should I pick? Well, the one that is consistent with maximizing my utility or obtaining the highest indifference curve that represents my investment objectives. So in this case here, portfolio C for this particular investor is optimal. And people that have greater risk tolerance will be above point C towards P, and those with less risk tolerance will put more in treasury bills and less in optimal portfolio P. But what does optimal portfolio P look like? It's a very large portfolio of stocks and bonds. So point C is like 45% in stocks, 38% in bonds, and 25% in T-bills. So in a lot of institutional investment management, this is the kind of stuff they try and fulfill. But they don't really use indifference curves. They put you in buckets. But they really don't solve for P. They use a bunch of large funds. And, you know, they can charge higher fees if they make them active. Okay. So my thought process was, look at the end result. The end result is really just a large stock portfolio, large bond portfolio, and T-bills. In the limit, for max diversification, the stock portfolio should be all stocks in the world that are tradable, all bonds in the world that are tradable, and T-bills. So for investor inputs, okay, so if I was going back here and said, oh, what should I use for investor inputs? I'm going to first create and maintain a personal balance sheet, okay? I can do that really quickly with online accounts. And second, I have to define investment objectives, and I'm going to do it in the form of a strategic asset allocation. So to make this real, they have to be tradable stock and bond portfolios. So why don't I just use real ones that are out there? And then depending on how I weight them, how, not me personally, but whoever the user is that's using Ripsaw Wealth Tools is going to select a stock, bond, and cash percentage that's consistent with their own personal investment objectives. Okay. Well, I need investment opportunities, but I'm not going to do this expected return standard deviation for each security. First of all, how do I come about that? That takes a whole lot of assumptions about, geez, should I use the last 30 days, the last 3 years of monthly data? Will that be a good representation of what I'm expecting in the future? It's pretty difficult, okay? But for investment opportunities here, we're going to access 56 intuitive risk dimensions for each investment and aggregate them into a wealth portfolio of risk dimensions. So when I say intuitive risk dimensions, what do I mean? Well, for bonds, what are the risk factors in bonds? Well, one is the probability of default. Oh, what can I use to represent that? Credit ratings from the rating agencies. So you've got ratings on each bond, and then if you can get it on mutual fund, bond mutual fund, and bond ETF funds for the whole fund, you end up with a distribution of ratings from the highest quality AAA down to BBB for investment grade, and then below investment grade, you've got BB and C and D, not rated, okay? So I can do that for credit risk. For interest rate risk, well, there's a first pass. The longer the maturity, generally the higher the interest rate risk or sensitivity to changes in interest rate. So I'll give you the distribution. I'll put in buckets. That's less than a year, 1 to 3 years, 3 to 5, 5 to 10, and so forth, okay? And we'll also tell you what sector it comes in, so we know something about the diversification of your bond portfolio. For stocks, yeah, and actually for bonds too, we want to know how much is US and non-US. And then for stocks, how much is large cap, mid cap, small cap, value, blend, growth, and what are is the sector distribution, technology versus healthcare and so forth. So those are all intuitive, and you can some are just for diversification, but some are pretty clear that the higher maturity I go in the bond sector, that's more interest rate risk. The lower the credit rating, that's more default risk and so forth. So we're going to use those because those are also easy for investors to understand. So now I've got the investor inputs and the opportunities. Well, just like this investment process, I need this financial modeling section. So we're going to do portfolio construction, monitoring, and revision. We're going to provide that modeling and screening tools for adding securities to portfolios and optimization tools for investment objectives. And finally, we will get to performance measurement. Now, just think about it. I've got this portfolio I'm managing. I also have the strategic asset allocation or benchmark of real funds. So I can see what the difference is in return to measure investment performance. Okay, let me just play you this fast video to just get a feel for how the data is organized. Okay?
Welcome to Ripsaw. Let's begin with a quick overview to get you started and in control. First, you'll populate your balance sheet by providing it access to all of your web-based bank, brokerage, tax-deferred, and loan accounts through connected accounts. Assets and liabilities can also be added manually. Now you have the complete picture for portfolio decision analysis. Next, you'll set up your customized benchmark. This is necessary to evaluate the relative risk characteristics of your portfolio, provide a target goal, and measure performance. Your benchmark reflects your investment objectives and can be altered anytime depending on life events. Now, you are ready to utilize the tools. Your dashboard will be your home base for indications of portfolio construction, monitoring portfolio drift, and revision decisions. Now, drill down on individual risk characteristics for each security and each account contained in your balance sheet. When you observe deviations from your benchmark or need to adjust for life events, you can start a revision. Revision mode allows you to consider new investments and altering current investments with our advanced screener. Then you'll be able to observe the effect on your overall wealth portfolio risk dimensions. To learn more about what each of these tools can do, check out our tutorials.
Okay, defining your investment objectives in the form of a strategic asset allocation is so crucial, and I think I should play this video as well to give you a little more detail on that aspect.
A convenient way to summarize investment objectives is a custom benchmark defined by the portfolio percentage allocations to investable market proxies for the cash, bond, and stock sectors. Ripsaw Wealth Tools starts up in net worth mode so that you can see your entire wealth picture. Click on the House and Car button to shift the dashboard to investment mode. John and Jane Saw's default benchmark appears below their current asset allocation in the Wealth Portfolio dashboard. The red warning circles are benchmark deviation indicators that indicate exceeding the threshold settings associated with their large cash overweight and significant underweight in bonds. John and Jane need to set up their customized benchmark before revising their portfolio. Select the Manage Benchmark icon. The first step defines the sector proxies to be used for low-cost, well-diversified, and readily obtainable cash, bond, and stock portfolios. Ripsaw provides a U.S.-centric default for the composition of the proxy portfolios: a government money market fund for cash, an investment-grade bond market index ETF for bonds and for stocks, 80% in the total U.S. stock market index ETF, and 20% in a total international stock market index ETF. Select the Global-Centric Market Proxies button for more international diversification. Note the larger allocation to non-U.S. investment-grade and emerging market bond index ETFs, and a total global stock market index ETF that has a much higher allocation to non-U.S. stocks. You can edit both the investment weights and choice of proxies for subsectors contained in each proxy portfolio. You are in control. Given the exchange rate, political, and accounting risks outside the U.S., the Saws prefer to start with the U.S.-centric default and only add some diversification with investment-grade international bonds and U.S. high-yield bonds. They click the plus sign next to bond market sectors and add U.S. high yield as an additional component to their bond market proxy portfolio. Next, they click on No Proxy Chosen, and then the Choose Security button to use the investment screener to find one. They select the Bond Fund column, reduce the expense ratio to a maximum of 0.25%, and eliminate actively managed and mutual funds. ETFs are preferred to get benchmark price updates when markets are open. Click Next to get a menu of bond subsectors. Select U.S. High Yield, and then choose a Low Expense Ratio, Low Cash Allocation Index ETF. Confirm selection and see the High Yield Index ETF added to the bond market sectors list. Then, they adjust the investment weights to include all subsectors of their customized bond market proxy portfolio. John and Jane are comfortable with their default proxies and their respective investment weights, so they continue on to the next step. An investor's strategic asset allocation is a good proxy for their risk tolerance. Generally, increasing the percentage allocated to common stocks will increase both the risk and expected return of a portfolio. The default allocation for risk tolerance is a stock percentage equal to 100 minus the age entered in the user profile. The older you are, the shorter your investment time horizon. That is, less time to recover from a market downturn, and hence a preference for a lower stock market exposure. A sensible entry might be the younger age of a married couple. In actuality, age is only one factor in determining your risk tolerance. Hence, you should modify this rule of thumb based on additional personal circumstances and preferences. For example, a couple planning some near-term large expenditures, like a home purchase down payment, might be more risk-averse and select a lower stock and higher cash allocation. A dual-earning couple with stable careers and low fixed expenses might increase their stock and lower their cash allocation. A retiring person may employ a downside risk strategy of the percentages in cash and treasury bonds that safeguard essential retirement spending and invest the remaining percentage in stocks. Since sector proxy mutual funds, or ETFs, have cash in their holdings for operations, note that the stock and cash allocation sliders have minimums and maximums. If a proxy stock portfolio's cash allocation is 1%, the maximum stock allocation is 99%, and there is a minimum 1% cash allocation to your custom benchmark. Ripsaw will account for the cash, bond, and stock percentages in the proxy portfolios when you select the strategic asset allocation and evaluation of the funds in your portfolio. John and Jane Saw settled on a 60% stock, 5% cash, and 35% strategic asset allocation. After saving and closing their customized benchmark allocation, we see it in the investment mode dashboard. After saving your custom benchmark, Ripsaw will enter and maintain its properties in the Wealth Portfolio dashboard, including mapping them to net worth mode. When the deviation of the current portfolio from the benchmark allocation exceeds a 4% threshold, it will be indicated in red. Between a 2% and 4% difference, it will be displayed in yellow. Below 2%, it will display a green indicator. Go to Settings to manage the thresholds. Any preferred threshold changes can be made here and saved. The deviations can be an unintended drift from their benchmark strategic asset allocation or a tactical asset allocation to take advantage of temporary market disruptions, valuation assessments, supply and demand imbalances in the marketplace, or near-term liquidity demands. Portfolio monitoring involves comparing these properties with your actual portfolio and identifying significant deviations. Then, unintended deviations can be reduced with actual portfolio revision decisions. Since John and Jane are just getting started, their next step will consider portfolio revisions to get closer to their customized benchmark.
Okay, you can see from there, we've added a lot of monitoring tools in the color codes, indicators, and you have total control of what boundaries you might want to set. I'm also quite agnostic as to things like market efficiency. So a passive investor might say, you know, I don't know anything special. I don't have time for this. I want to spend time on my day job. I just want what the market is offering me in additional returns for investing. So I'll try and match my benchmark. Other folks get into more active management in the sense of saying, okay, I'll take advantage of my long-term investment horizon. And especially when there's an event like we've had in the past year, but certainly last March, the short-term investors were pushing stock prices down dramatically, and the market went down about 34% last March, or February, March. VIX went to 80, and people could say, well, you know, this is going to get resolved at some point, and I've got many years ahead of me, so I would add stock at that point and go over my benchmark weight, okay? And when VIX is now back down to 17, trading out of that position and going back to strategic asset allocation may make perfect sense. So we just want to provide tools for people to take any position they want and be able to find portfolios that make sense. Actually, this very last statement I love: maintain intended risk exposures while minimizing unintended exposures. In the same way that if there's risk that you're not getting compensated for, you want to eliminate that. Now, when I said to you earlier, I want my family and friends and others that I help not need me anymore, the place that they would always get stuck is, well, I don't know what additional investments I might need. I've got a bonus just came in, where should I put it? They always want my approval, but I want to wean them off of me. So that's when we added the Ripsaw Optimizer. to solve for the user's preferred asset allocation. And notice we're doing this across many accounts, and there can be many investments in each account. And with one click, what that optimizer is doing is it's calculating the deviations between the dollar you have invested in a particular risk exposure and what the benchmark is. And it's going to sort through all your investments and change the weights and get to the point where it minimizes that average deviation across all the risk dimensions. And it's nice to do that with one click. Now, if you have a portfolio that's kind of left there and you want to see how to improve it, you can click that optimizer. And it's going to give you a solution. But that solution is based on what's in those accounts. Okay. So the next step it's not artificial intelligence, but it's in that vein of saying, you know what, let's analyze the portfolio that's been optimized and try and identify all the underweights in exposures relative to the benchmark. Because we know if there are overweights, well, the optimizer would just sell those if it could. But it may not have access, it may not have investments available for these underweights. So you need to add securities to the accounts. But first you have to identify what you need. Then you have to use our advanced screener to find what you can add to those accounts, and then quickly and efficiently add it to the right accounts you want it in, and then perform an updated optimization. So after you've done that, you go back into the assist tool and see, gee, is there something else left? And if there are, you go through the same process of adding securities and re-optimizing until you can't improve your portfolio positioning anymore. So through that process, you can create tax-efficient strategies, you can implement tactical strategies, and you can just do your strategic asset allocation. Any of those can be implemented with position sizes and constraints. So for each security, you still have a constraint of saying, I want to only invest exactly $10,000 in this security, and we'll optimize around that. So you have those abilities. And so what you're going to see in the next video is the application of asset location, adding investment opportunities, doing so in an after-tax efficient way. Those that want to just match the benchmark, passive strategy. And then a couple examples of active strategies where we're going to overweight a particular bond because we have some special access to a feature we like in the TIAA traditional bond. And then we're going to do a couple of stock allocations, overweight Apple and Tesla, which has been a favorite for a while, but my son has loved that for years. And he actually has a 13,000% return on Tesla. Can you believe that? But for good discipline, you also have to know when to sell. So we're discussing that. Anyhow, let me play this video for you.
Your asset allocation decision can be the most time-consuming and calculation-intensive activity in wealth management. The Ripsaw Optimizer is designed to solve for your preferred asset allocation across numerous securities with 56 risk dimensions across many accounts with one click. Our approach to disciplined investment management requires that you have already created a custom benchmark that is consistent with your risk tolerance. If not, view the Configuring Your Benchmark tutorial before continuing. Your wealth management objective is to simultaneously match all of your benchmark risk exposures. Any deviation produces incremental risk. Tactical trades have intended temporary risk exposure deviations for performance enhancement. The optimizer can be used to maintain intended risk exposure deviations while minimizing unintended ones. We begin with a simple portfolio construction example, then add more accounts with a variety of investment scenarios. Ripsaw provides a traffic light style color-coded set of threshold benchmark deviation indicators to alert investors as to how far each of their current and revised portfolio risk exposures are from those in their custom benchmark. In our first scenario, it's easy to identify that Jane and John Saw's current wealth portfolio is significantly overweight in cash and underweight in bonds and stocks. You can also click on Differences for the calculation of percentage and dollar differences of the current portfolio allocations minus the benchmark allocations in each sector. A positive number is the overweight magnitude, while a negative number is the underweight magnitude. Minimizing portfolio risk exposure deviations from those in your benchmark strategy is an effective methodology for the process of portfolio construction. After initial construction, they are a monitoring device for unintended drift away from investment objectives, as well as a guide to portfolio rebalancing decisions. There is also a Go to Column Group drop-down menu of risk dimension groupings with deviation alert indicators. The composition of the stock and bond portfolio risk exposures are also available from here. Selecting the Bond Global Distribution will move that group to the front of the dashboard to observe the significant overweight in U.S. AAA credit quality 1 to 3 year maturity and the government bond sector relative to the benchmark. A significant risk exposure overweight implies that there is an underweight in one or more other risk exposures. Selecting the Stock Global Distribution will move that group to the front of the dashboard. Given the current portfolio has no stocks, there is an underweight in all stock risk exposures relative to the benchmark. In this instance, the overweight is in cash. Although it is clear that Jane and John Saw need to buy more stocks and bonds, it may not be easy to determine which stocks and bonds to buy and sell to simultaneously best match their custom benchmark's detailed 56 risk exposures. That is a lot of moving parts. Select Start a Revision and click Expand All to open all accounts. Then open the Ripsaw Optimizer drawer and click Pre-Optimization Tips for a list of preparation concepts. Think of these as a pre-flight checklist before embarking on your optimization and revision. Jane and John have a savings account with a low interest rate and no additional investment opportunities. Since they can have a cash allocation as well as other opportunities in their brokerage account, they use the Account Actions menu to transfer that cash to their joint brokerage account. Now the Saws have to add bond and stock investment opportunities to their brokerage account. Since they want to match all the risk exposures in the benchmark, they use the Account Actions menu to add the same funds that are in their custom benchmark: BND for the investment grade total bond market, VXUS for the non-US total stock market, and VTI for the total US stock market. VMFXX was already in the account as a source of cash and the 1 to 3 year maturity, high-quality bond sector. In the revision section, you can enter an investment decision with either a dollar, quantity, new value, or new allocation number. The other 3 columns will be automatically calculated. As you make individual security changes, the effect on your aggregate revised portfolio can be observed in the middle row of the dashboard. In the benchmark row, the indicator color and differences will all be calculated as the revised portfolio risk exposures relative to the benchmark risk exposures. It may be reasonable to use trial and error when dealing with a few accounts and a small number of investments in each. Enter a new allocation percentage and observe that Ripsaw calculates the dollar, quantity, and new value in the other 3 columns for each investment. The dashboard indicates all the revised portfolio risk exposures relative to the benchmark across and within the composition of the cash, bond, and stock portfolios. While trial and error can be used to move your portfolio in the right direction, the revision process is more efficiently executed with the Ripsaw Optimizer. Click on the Optimizer. In the Ripsaw Optimizer drawer, you have a choice of which risk exposures to include in a minimum deviations optimization. By default, all risk exposures are included. The current deviation column contains each risk exposure's deviation in the current portfolio from that of the benchmark. Click on Minimize Deviations to run an optimization which will fill in the minimized deviation columns. Note that these results are also contained in the dashboard differences from the benchmark. Scrolling through all of the detailed cash, bond, and stock portfolio risk exposures, both in percent and dollars, the revised portfolio deviations from the benchmark are trivially small, with all green indicators. In contrast to the current portfolio, the optimized portfolio is a very close match to the benchmark. A measure of the benefit of moving from the current portfolio to the optimized portfolio is the percentage reduction in aggregate deviations from the benchmark. Almost 100% indicates a very close match with the benchmark strategy. The solution includes the specific dollar amounts and number of shares for the purchases of VTI, VXUS, and BND from the amount to sell from VMFXX, along with the use of unallocated funds. Using the Revisions Actions menu to click on Save As and entering a revision name will provide a summary for revision that will also be saved and can be recalled for the list of transactions to be executed in each account and transfers between accounts. Note that these transaction values are guidance. Depending on how soon you execute trades, prices may change enough to require a re-optimization. You will mostly be making purchases in whole number shares, not to the precision of the decimal places in the revision section. A sensible order for trade execution at your financial institution is to first move cash between accounts, then execute all sell decisions, then use each rounded down number of shares for purchases, but with the last purchase using up as much as possible of the remaining balance. After all transactions are executed and cleared at your financial institution, you can come back to Ripsaw and refresh accounts to see the characteristics of your revised portfolio. For the second scenario, add Jane Saw's IRA account to their wealth portfolio. Jane has already added the same investment choices to her IRA as the Saws have in their brokerage account. Select the Ripsaw Optimizer and click on Minimize Deviations to obtain an extremely close solution for asset allocation that matches all risk exposures of the benchmark. Not really a surprise, given that the Saws are giving the Optimizer all the investment opportunities that are in the benchmark in both accounts. Without additional constraints, there are actually many solutions to achieve the same result. The percentage reduction in aggregate deviations from the benchmark is almost 100%. However, this solution is not taking advantage of the tax-deferred status of Jane's IRA, where it is better to allocate bond funds and high dividend yield stock funds. In the dashboard, the sum of the benchmark allocation to bonds and to non-US stocks is less than the account value. Therefore, in the brokerage account, Jane edits the new value cells for BND and VXUS to be 0 and places a hold constraint on each. This will force the optimizer to not purchase any BND or VXUS in the brokerage account and buy them in the IRA account. Select the Ripsaw Optimizer and click Minimize Deviations. Observe the trivially small deviations from the benchmark for all individual risk exposures, and the aggregate portfolio reduction is near 100%. The solution is as expected. In the brokerage account, there is no allocation to either the bond fund BND or the total international fund VXUS. Investment is mostly in the total U.S. stock market fund VTI. The necessary allocation to BND and VXUS is in the IRA account with very little allocated to VTI. If the allocation to BND and VXUS would have been larger than the size of Jane's IRA, she could set feasible new value amounts with either hold or greater than or equal to constraints. Then take off the hold constraints in their brokerage account, so the remainder of investment in these securities will be allocated to their brokerage account. Moving on to the third scenario, add the John Saw Rollover IRA to the mix. This account is the largest in the Saw Wealth portfolio, but has no bond fund opportunities. It does have a large cap stock fund and big positions in 2 large cap individual stocks, but no small or mid cap opportunities. Therefore, John adds the total bond market fund BND, the mid cap fund VO, and the small cap fund VTWO. Having U.S. large, mid, and small cap funds will allow the optimizer to find the investment weights that closely replicate the total U.S. stock market benchmark portfolio. In their brokerage account, BND and VXUS remain set to 0 new values, with a hold constraint on each to move these higher-yielding assets into tax-deferred accounts. They open the Ripsaw Optimizer and click Minimize Deviations to get an asset allocation within and across all accounts that is very close to the benchmark in all risk dimensions. Every one of the 56 risk exposures are close to the benchmark, and the aggregate portfolio deviation reduction is very close to 100%. This solution included the good after-tax decision of the bond fund BND and total international fund VTIAX being in the tax-deferred accounts and not in the taxable brokerage account. The optimization also sold almost all of the individual stock holdings in John's rollover IRA in favor of the well-diversified stock funds with no immediate tax consequence. John realizes that AAPL and TSLA are proportionately represented in the diversified large cap part of their available stock index funds. However, he believes they are both still undervalued and wants to tactically overweight them until the market prices agree with his assessment. He also now realizes that it is more efficient to hold these growth companies in their joint brokerage account, where capital losses can provide the harvesting of a tax deduction, or future realized capital gains will be taxed at a lower rate. In his rollover IRA, John makes sure each individual stock has a $0 investment and places a hold constraint on each of them. Then he adds AAPL and TSLA to the Jane and John Saw brokerage account, enters the dollar amount he is comfortable with being overweight in each, and employs the hold constraint for each. He then goes to the Ripsaw Optimizer and clicks on Minimize Deviations to obtain a preferred solution. Examining the risk exposure deviations, they are all close to the benchmark, except for the overweight in growth stocks, causing the underweight in value and blend stocks, as well as the overweight in the consumer cyclicals and technology stock sectors. These are consistent with John's tactical decision to overweight AAPL and TSLA. Even though these are large cap stocks, the large, mid, and small cap allocations are close to the benchmark. The optimizer selected less large cap stock exposure elsewhere in order to accommodate the AAPL and TSLA overweight. Note that the aggregate reduction in deviations from the benchmark is less than without the tactical stock positions. The difference is the incremental risk, or give up in diversification, for the additional expected return on the AAPL and TSLA overweight. It is the optimizer solution across all accounts that minimizes this incremental risk at the wealth portfolio level. There are many complex situations for which the optimizer, with sensible inputs, can provide a preferred solution. In the fourth scenario, they add 2 more accounts. Jane has a 403b retirement plan from a previous employer. This TIAA traditional investment has a lot of options upon retirement, including the purchase of an annuity, cash out over 10 years, or just taking the required minimum distribution. Since Jane will not make this choice until retirement in 25 to 30 years, the investment can be viewed as a variable interest rate bond with a guaranteed rate floor that accumulates in value. Since the necessary data is individual specific and future decisions cannot be provided by TIAA, Jane uses Ripsaw's data override feature to set reasonable proxy risk exposure values of 100% bonds, 3% yield, 100% US bonds, 100% AAA credit quality, 100% in the 20 to 30-year maturity bucket, and 100% in the government sector. Jane's current job includes a 401k that has very high expenses and poor investment choices. The lowest expense ratio is still very high at 0.6% for an S&P 500 index fund, but that is the least bad option available. Maintaining that single choice means that Jane and John will get their other benchmark matching exposures elsewhere in their wealth portfolio. They select the Ripsaw Optimizer button and then click on Minimize Deviations for a solution. The results are a lower portfolio reduction than the prior optimization, implying more incremental risk. The standalone traditional TIAA bond investment resulted in a new significant overweight in the AAA, 20 to 30-year maturity, and government bond risk exposures, and a significant underweight in MBS, corporate bonds, and shorter maturities. Since TIAA traditional is most similar to a long-term government bond, they add other bond market subsector funds to John's rollover IRA, an MBS fund, short, intermediate, and long-term treasury funds, and short, intermediate, and long-term corporate bond funds. The optimizer now has the flexibility to more closely replicate the bond portfolio benchmark risk exposures, with the constraint of holding Jane's TIAA traditional investment as equivalent to a long-term government bond investment. Jane and John select the Ripsaw optimizer and then click Minimize Deviations for a solution. Note that the aggregate reduction has increased to about where it was with the still maintained tactical overweight in AAPL and TSLA. In the aggregate bond portfolio, the only remaining modest deviation from the benchmark portfolio is an overweight in the 20 to 30 years bucket and an underweight in the 15 to 20-year maturity bucket. We also see the maintained AAPL and TSLA overweight in growth stocks, consumer cyclicals, and technology sectors. All the decisions necessary to achieve Jane and John's investment objectives are in the revision section dollar change or quantity change columns in each account. In the prior optimization, BND had a large role in John's rollover IRA account. In this optimization, there is little BND, as matching the benchmark bond risk exposures is more efficiently accomplished with the combination of MBS, short and immediate term corporates and treasuries, along with the constrained long-term TIAA traditional investment. Using the Revisions Actions menu to click on Save As and entering a revision name will provide a summary for revision that will also be saved and can be recalled for the list of transactions to be executed in all accounts at their financial institutions. After implementing an optimized portfolio revision decision, monitoring your wealth portfolio is required to maintain a strategic asset allocation, execute tactical trades, purchase or sell a home, refinance a mortgage, add Social Security and pension benefits, and manage cash inflows and outflows. These events can be analyzed with a new revision to achieve wealth portfolio investment objectives. In summary, the Ripsaw Optimizer provides you with maximum control of your investment process with the least amount of effort.
I have a couple examples here quickly of tilts. One is to overweight small versus large capitalization stocks, and the other is what we talked about before of taking on more corporate default and mortgage prepayment risks. I did this before I had the optimizer, and basically the principle is unbundling the risk dimensions and being able to manage them separately. Very important finance concept. So here I just used a large cap, mid cap, and small cap fund to replicate what a single total stock market fund would have. And with those weights, I did through trial and error before I had the optimizer, you can see that the benchmark is very well matched across all the risk dimensions. But then if I want to overweight small cap, an example here is moving 12% to small cap and funding it with reducing large cap by 10 and mid cap by 2. The nice part here is I get exactly what I want in underweighting large cap and overweighting small cap while simultaneously being neutral to mid cap, neutral to the value blend growth, and neutral to the sector distribution. So I didn't affect a lot of the diversification aspects of the strategy, but instead I isolated the trade between large and small cap stocks. Can do the same thing. BND is the total bond market, which has prepayment risk, credit risk, and interest rate risk. So I'm using two funds to represent mortgage-backed securities or prepayment, and to represent credit risk, a corporate bond fund. Now, both of these have interest rate risk, as well as representing the treasury sector across different maturities, short, intermediate, and long. And notice the replication works very well. The only little bit of overweight in MBS and corporates is to accommodate the fact that in BND there is some CMBS, some convertible bonds, and some ABS that's not included in my subsectors. But again, 10% overweights in VTC and VMBS, funded by taking 20% out of treasuries. But notice I didn't take out anything out of the long term, mostly out of intermediate term and small and short term funds. And we get exactly what we want, underweight high, the AAA, and we've tilted towards more single A and triple B than the benchmark. And of course, overweight agency MBS corporate as expected at the expense of selling treasuries. The one thing of interest here that I will point out is we end up overweight in the 20 to 30 year sector and underweight in the intermediate area. And the reason for that is I purposely took the money, most of the money out of the intermediate sector, because I know that a 30-year mortgage-backed security is very different from a 30-year treasury. And our source of data here through Morningstar classifies, because of its maturity, a 30-year mortgage-backed security in the 20 to 30-year bucket. Now, there's a big difference between a 30-year treasury and a 30-year mortgage-backed security in terms of interest rate risk sensitivity. At the end of 30 years in the treasury bond, you have a big principal repayment. But in the mortgage, principal is paid back evenly throughout. Not evenly, actually. Less in the beginning, a little more at the end, but throughout the 30 years. And there's also potential for prepayments, which will end at that moment, the maturity of the issue. So clearly, with more cash flows coming earlier, mortgage-backed securities are typically more like intermediate term bonds than long-term bonds. So the right measure for this is using an analytical measure called duration. And since Joe's going to cover more on bonds shortly in your course, you can delve into that example more deeply. Well, I think we've come to the end of our time. Actually, I went a little over. Sorry about that. Very interested in your feedback, and through, I know you're all signed up for Ripsaw Wealth Tools, and between that and the website, ripsaw.co, you can send me feedback. I'm very interested in the user friendliness so that we can move ahead in this product. Thank you very much. Joe?
Yeah, thank you so much, Stan. It's a great talk, and hope everyone got something out of that talk and learned more about Ripsaw, and I think especially about some of the concepts behind it. We've discussed the mechanics so far, but I think this gave you a really good view of the finance behind it, and we'll be enhancing that some with an assignment. So you should expect your first Ripsaw assignment. We stopped Stock Track. We won't be doing any more Stock Track assignments. So we'll probably send out a Ripsaw assignment either tonight or tomorrow morning. And then we'll do one more of those, and that will take us to the end of the semester. So yeah, thanks again, Stan, so much, and really appreciate you coming here.